What is macro trading? Global macro trading means making large, highly leveraged bets on the direction of financial markets, currencies, commodity prices, stocks, bonds, all based on macroeconomic analysis. The goal is a holistic view of the global economy, influential events, politics, interest rates, and key economic data, and how all those forces affect asset prices. The global macro strategy allows funds to place any type of trade on almost any type of security in any country of choice. It's the broadest possible canvas in investing. George Soros. Who is he? George Soros is a billionaire investor and founder of Soros Fund Management, widely recognized as one of the most influential investors of all time. He co-founded the Quantum Fund with Jim Rogers in 1973, which quickly became one of the most successful and influential hedge funds in history. He earned the title the man who broke the Bank of England after his famous $1 billion profit from shorting the British pound in 1992. How it works. His approach. Soros pinpoints major economic changes, currency swings, shifts in interest rates, political turmoil, and positions his investments to profit from their ripple effects across stocks, commodities, and currencies. His team is not interested in what a company will earn next quarter. They focus on how broad social, economic, and political factors will alter the destiny of an entire industry or stock group over time. High conviction trades are central to his approach, taking large, calculated risks based on macroeconomic insights when the opportunity is clear. The reflexivity theory. Soros disagreed with the idea that markets are rational. He believed markets are driven not just by fundamentals, but by people's perceptions of those fundamentals, and that those perceptions can actually influence reality. He uses this insight to spot moments when market expectations stray far from reality, giving him opportunities to capitalize on the resulting inefficiencies. In his own words, the objective is to ride the economic trends whose premise is false and step off before it is discredited. Breaking the Bank of England. 1992. In the early 1990s, Britain was part of the European Exchange Rate Mechanism, ERM, a system meant to stabilize exchange rates ahead of a common European currency. Soros and his peers borrowed a massive amount of British pounds and sold them simultaneously, causing the exchange rate to crash violently. The British government spent nearly $26 billion in reserves trying to stop the decline and failed. By the end of the day, the UK withdrew from the ERM and devalued the pound. Soros made over $1 billion in profit, a trade that redefined what macro trading meant. Track record. From multi-asset diversification to high-conviction macro trades, Soros showed that with a strong understanding of global economics, an investor could make monumental strides, forever changing the hedge fund industry. His approach involves clear exit strategies and being prepared for multiple outcomes, including losses, disciplined risk management paired with the bold conviction.